Right now, it's the markets, they're a bit different than what a lot of people have dealt with over the past 10 years. What's your outlook and what changes have you seen? Obviously, at the end of 2018, it was a bit more challenging. Moving into 2019, we saw some growth. So what do you see moving forward and what are you looking at?
Yeah, so the challenge that we came up with, that we experienced in 2018 was twofold. One, evidence that the global economy had cooled from its 2017 pace. And people, when they experience the volatility that we had in 2018, forget what a wonderful year 2017 was, where we had double-digit equity market returns worldwide. The concern about a global slowdown is being driven primarily about what's happening with China. Some of it is related to the trade dispute that China and the U.S. are having, but that dispute, along with signs that the industrial activity within China has kind of slowed down, partly because of some measures that the government had taken to sort of pull back lending, to pull back, pursue sort of more green-friendly policies and so forth to try to reduce the air pollution and so forth. But that kind of had a knock-on effect that caused the economic growth engine in China to slow down a bit, and that's being felt worldwide. We're seeing that, for instance, in European industrial production numbers, export activity, particularly in Germany. And so that was the concern, I think, that was the overhang that weighed down equity markets and fixed income market performance. And the second component was the Fed, the Federal Reserve. Yep. So the Federal Reserve has a lot of influence over the markets, and that's partly because the U.S. dollar currency itself is a widely adopted currency and is kind of viewed as the driver of capital market liquidity. And so when the Fed has initially in 2016, 2017, they started to reverse their years of easy monetary policy that was implemented following the 2008 financial crisis. They felt that the U.S. economy was on firmer footing that could support perhaps a normal monetary policy, which translates into higher interest rates and maybe less liquidity and so forth. And the market seemed fine with that when it was evident that the U.S. was in fact on firmer footing like we saw in 2017. But 8 rate hikes later and coming into 2018, and then in particular in the fourth quarter, when the Fed had communicated that we were far from neutral, that's kind of what freaked the markets out, that perhaps the Fed would over-tighten, reach on interest rates and push the economy into recession. And particularly in a period where we're seeing sort of a slowdown in global trade activity with the trade disputes and so forth, and it just, the market investors were concerned that we couldn't handle any sort of further policy normalization by the Fed. And so it was kind of those two things that really, I think, drove the fourth quarter sell-off. And fortunately, we've seen a strong recovery so far, at least this quarter. I think some of it was technical in the sense that a lot of the selling that we saw in the fourth quarter was driven perhaps by tax loss harvesting, investors taking an opportunity to lock in capital losses to offset gains and so forth. And so when you see kind of that technical selling pressure happen, that reverses or unwinds come the new year, and that's the so-called January effect. And so we saw a little bit of that this month, but also, we're slowing down. Yep. But does it mean we're going into a recession? I think that's kind of the critical question that the markets will be facing this year. But so far, at least, given how strong the employment picture is here in the U.S., it's hard to believe that we're going to be entering into a recession. Recessions typically happen because imbalances form in the economy, whether it's in the U.S. economy or globally. But typically what tips the economy over into a recession is when you have those imbalances form to a point where they're not sustainable, and you have a Federal Reserve that is hiking interest rates in response to economic strength. That typically is what pushes the economy over into the edge, over the edge. And so fortunately, I don't, unlike what we saw in 2008 or even in the late 90s during the internet telecom boom, there aren't any major imbalances that we can identify, at least within the U.S. Maybe you can say China has a lot of those imbalances, and that's what's being corrected right now. But at the very least in the U.S., those imbalances aren't evident, and now the Fed is on hold, so the risk of the Fed tipping the economy over the recession has certainly lowered.
So you're expecting still steady growth or slower growth, but you're expecting growth, correct?
Yes. So, slower growth, but not a recession.